the Growing Your Own Money podcast. Dean Thorpe, a CEO and financial advisor, and his son James Thorpe, a social media marketing business owner, sit down and discuss all things to do with money, goals, business, and the markets.
So, we've just got to the end of January.
Yep.
Right, obviously, the new year, the end of the first 31 days of the new year.
12th of the year gone.
That's it. It goes,
only 11 12ths to go.
It goes faster than you think, doesn't it?
Absolutely.
Definitely. So, sort of where we wanted to start was what we've seen so far this year in the markets and in the business world, and then maybe exploring what you might be predicting or expecting to see.
Yep, okay. So 2022 was a challenging year. 2023 was what I call a partial recovery year, where generally speaking the economy rebounded from the challenges of 2022. That was driven largely though by the kind of tech sector, particularly AI, artificial intelligence, driving really the top 5 or 6 stocks in the US market. And if you were exposed to those stocks, then you're laughing, frankly. You've done extremely well. If you were overexposed to those stocks, you've done amazingly well. And therein lies the first red flag. You know, if you're overexposed, you've done brilliant. Are you now overexposed to the detriment of some of the other stocks and funds that are, to some extent, lagging behind or might even look like they're underperforming the market? And we've started to see this shakeout now the last couple of months. So we had the what was widely known as the Santa rally in the run-up to Christmas, where everything started to move positively again. January's been more of a kind of settling down, bedding in, but we've definitely seen a little bit of movement away from the kind of top 6 or 7 stocks in the US market to more of a leveling of the playing field. Not massively, just little indications that that's beginning to happen. The thing about markets is that they are over efficient. So in 2022, when we saw the sell-off was over the top. I often refer to it as a kind of, what do you call that? A pendulum effect, okay? So you've got a pendulum with markets. Yeah. So the pendulum swings one way and the markets go, whoa, largely driven by sentiment. They go markedly over the top. There's a significant sell-off. Yeah. And then you have the entire investment world making peculiar decisions on the back of that. A number trying to take opportunities, a number selling out because the thing has gone down. And then you get other people, like maybe active fund managers, trying to look for the opportunities in the market, find anomalies, what's going to swing back quicker, faster, better, stronger. And in actual fact, if you can be a bit more patient, the market will sort itself out, because what we saw last year was the pendulum didn't swing right back. It swung a bit with X number of stocks, as I've alluded to. Yeah. And I think there's further to go during the course of this year as this year plays out, because a lot of the pricing now in the markets is all based on what we think or believe is going to happen. So the sense that inflation is beginning to be perceived as being under control. Interest rates are perceived to being at their peak. And what we will then hopefully begin to see is the markets catching up with that. So the stocks that have been left behind in 2023 should theoretically start to rise again, and you get a bit of a shakeout. The kind of top 5 or 6 stocks don't necessarily drop off. They might just not rise as quickly. So you could get that happening. Yeah. But I'd definitely an expectation that the rest of the market will start to rise during the course of this year. There's certainly a kind of element of the rest of the recovery to come through, alongside the fact that we're expecting a nominal return as well, in addition to that. Okay. The thing that's different now in this environment compared to 2 years ago is that yield is back. So you've had yield from the stock market purely through dividend returns, but for the best part of a decade, from round about 2009-10 up to round about 2022-23, there's been very little yield from interest rates and bond yields. That changed significantly last year. So during the course of 2024, we should start to see income delivered through bond yields and interest rate yields as well, which we've not had over the course of a calendar year for many, many years. We had it partially last year, but this year will be the first calendar year when we should really start to see it.
Understood. Yeah, that makes sense. And so with those AI companies, obviously with the things that I do,
Yeah.
I'm quite sort of into it and exploring ways that I can utilize it to benefit me.
Yeah.
So could you allude to maybe what some of those companies are and sort of where you expect AI to obviously it's always on the move and it's always progressing and new technologies coming along, displacing things in the market. So where do you think they could potentially take off to or not take off to?
You've probably seen a lot of the value being priced in now already.
Okay.
As a consequence of what happened last year. So now there's got to be that delivery. So with the large companies like Microsoft and Apple and others in that kind of sphere, the really big companies, a lot of it, the earnings expectation is priced into that share price rise that we saw during the course of last year. Now, if that comes through in their results, their financial results during the course of the year, then that will simply confirm that the share price is accurate. And then you've got everything in between. You could have, well, was it accurate? Was it better than expected? In which case the share price moves a bit more. Was it actually over expectation? So the share price has gone a little bit too high, in which case you might see it pulling back. But remember, these companies are still making significant profits. So that's why I say it depends on how you're exposed in terms of any savings and investments that you've got yourself. It's not about saying, oh, that's it now, it's finished. We dump all of those and we buy into something else, try and find the next trend. That's where you can start getting your fingers burnt if you're not careful. It's more about what's my weighting? Am I a little bit overexposed, in which case I could sell a little bit of that particular area, maybe buy another area, or some investments do have what's called an automated rebalancing effect. So the profits on the one hand, on a quarterly or 6 monthly basis, are automatically semi-sold and re-evaluated back into the rest of the market, which you can get funds doing. In terms of what AI is doing, definitely a disruptor, isn't it? In terms of being able to do new, incredible things. Only this last week, I caught your mum doing some transcribing, and she was literally tapping away, earphones on, listening to the recording, pausing it, stopping, and I said, "What are you doing?" She said, "I'm just transcribing this thing." So it's probably a 3-minute thing. I reckon that would have taken her 90 minutes, probably 60 to 90 minutes to transcribe it. So I stopped what I was doing and I said, right, let's just spend a little bit of time trying to figure out if we could use the transcribe tool within Microsoft, within Word. In other words, utilize just a teeny tiny bit of AI. It took us probably 15, 20 minutes just to suss things out, do a little bit of research, figure out whether she got the right app on the phone, upload that to a file within Microsoft, because you've got the changing technologies from an Apple hardware piece of kit to a Microsoft piece of kit. But when we'd ultimately done it, the actual clicking the button, using that file that we'd uploaded into Word to transcribe it, was seconds. And then all that your mum had to then look at doing was, right, it's there, I've just got to cross-check it now and make sure that what the AI system had read was actually accurate. So definitely saved her 60 minutes. So it probably cut it, let's say if it did take 90 minutes to do it, it's probably taken 30 minutes. Had everything already been set up, you add another 20 minutes in for the first time that you're doing it, but then once you've done it, it's there, isn't it?
Yeah.
You're off and running.
Yeah.
So that is just a teeny tiny bit of a massive piece of new generation tech that is now available. Definitely. I mean, how are you using it?
So, I mean, just thinking some of the cases where I'd use it is sort of idea generation. So when I'm planning social media posts for businesses, I'll use sort of your chat GPTs, your Bard, and literally utilize it to help me come up with ideas for posts. Could be a broad theme, and then I'll input a theme in, and it'll give me an unlimited amount of options. So you could say 25, you could say 50, you could say 100, and it'd do it within 10 seconds. You've got 100 ideas for content. Now, some of them, that being said, aren't great, but if you go through it and you sort of add your own spin onto it, you can make save a lot of time and come up with some ideas which you probably wouldn't come up with yourself in no time at all. And that sort of helps in the sense that it's man hours, so it's saving me time, and it also means I can be more efficient. So where maybe in the past someone in my position would have had to pay somebody for like generating the content and the ideas, now I've basically got a little robotic slave doing the work for me for free, and it's literally at my fingertips, and it's doing it exactly what I
and it's not that you're not being creative, it's you're just using that as the baseline for creativity. Then you're adding your creative acumen in addition to it, an artistic license, isn't it?
And the other thing I've been using it for, which seems to be improving all the time, is image generation.
Right.
So literally you type in little prompt, it could be financial advisor, and his son sat doing a podcast in a room with white walls, and he'd come up with something that looked just quite shockingly like this. So it's and I think there's probably a lot which hasn't been released yet that's already there in the background, whether it's with OpenAI, whether it's with Microsoft. They've already got this technology, and they're probably a year, if not 2 years, in front of where they've released it to. So obviously the possibilities with it are quite huge.
And taking it back to the kind of market side of it, that's why you've seen such significant share price growth, because for businesses like Microsoft, keep using them as a positive example in this sphere, they generate revenue through licensing. So if they can then add an AI element to their software suite, which they have done with Copilot, then that's an additional license that they can sell, which means additional revenue to an existing customer as well as potentially new customers. That's where you need to be generating revenue, because then that adds to their earnings, which justifies the share price movement.
Definitely.
Now, what you've also got to think about is that there will be smaller, nimbler companies that are also trying to explore what AI means for them and their businesses. Does that then mean that those companies have got the potential for exponential growth? That's something to consider further as well. And it's another element to the investment world entirely.
So that's sort of the artificial intelligence side. The markets as we see it at the minute. Obviously you go about advising people in what they do. But how, I imagine that the way that you help people with their investments is similar to the way that you personally go about doing your investments.
Yeah, absolutely.
Sort of practicing what you preach. So what sort of thing did you take into account when you're looking at, could this be a good investment, or is this one maybe not? Like sort of figuring out the best places to be in the market and things to add to your portfolio.
Well, you've probably gone too far down the line in terms of that question, and it's more about stripping it back to basics. Savings and investments is about short, medium, long term. Sure. So your short term element, you're in a great environment at the moment because we've gone from interest rates virtually zero 18 months, 20 months ago
Yeah.
to, in the UK, the bank base rate is just being held today at 5.25%. Wow. You know, you can get close to 5% on your money for doing nothing. And my youngest son can't get his head around that. How am I getting paid interest on money that's in a bank account? Because he's never seen that before. He's seen little bits of pence, but now it's pounds.
Yeah.
So your short-term money, definitely worth shopping around for your easy access savings, potentially tying up a little bit on a fixed term basis.
Yeah.
And that's got to be money that rainy day, discretionary spends, ad hoc spends over and above any regular income that you might be needing. That's where you put your savings.
Yeah.
It changes from time to time. National savings in the UK are always worth having a look at and comparing that against other banks and building societies. High street banks still tends to be the lower paid rate. So definitely shop around in that respect. Your more medium term is then having a look at exposing some of your money to real assets. So in other words, investing it into a fund of some kind. And when you're looking at that, you can be too clever, you can get too complicated and start investing in fund after fund after fund after fund. I've seen portfolios even in the last 6 months which have got exposure to 20 to 30 funds. And whilst on the face of it, that might feel like a good thing, in reality, when we start doing our X-ray analytical checks, what it really boils down to is it's far too diluted. It's probably not got enough exposure to a particular part of the market to give you that genuine return. And you're actually dragging the potential reward or the potential performance by paying too much in fees or dealing costs from having just so many different funds. So for your kind of more medium to long-term investment strategy, I often look at a core holding in something dead straightforward based on someone's general appetite for risk. You know, are they, A, they've got to be comfortable taking some risk, but B, they've got to look at the timeline that they're investing in as well. Is this going in for 5 years, 10 years, longer than that? And they can then look to build up a kind of core holding that gives that financial security. It's in real assets. It's something that's going to be invested for a considerably long period of time, and it's going to deliver a return. And it's not going to overexpose them to one particular area of the market, whether it's the top 6 in the North America or the next best thing in Southeast Asia. It's giving that good spread of assets. There'll still be a weighting based on the market overall, but it's giving a good spread of assets and companies. In addition to that, yes, you could have some kind of satellite strategies where you might want to invest in a specific area with, let's say, additional tranches of money. So you've got that core, but you might have a personal appetite for something you want to play out, or there might be a perception that you feel the market in a particular area is undervalued, so you might want to expose yourself to that. And that's something that you would discuss with an advisor. It's certainly something that you always look to consider, but you just got to be careful that you're not looking for the next best thing, the next theme, because again, you can sometimes get your fingers burnt chasing the money, whereas that kind of core traditional element can be good.
Yeah, timing the market rather than timing the market.
You see this all the time, but the psychology of investing, which we can perhaps talk about in another podcast, is just phenomenal. It's all about getting the money in, leaving it there, letting it do what it's going to do. Yes, there will be times when it's negative, but over the long term, it should be positive if you've exposed yourself to the right element of the market.
Yeah, and investing with logic rather than investing by emotion and seeing a drop and thinking, oh no, I need to pull all the money out.
Exactly.
No, actually, if you just leave it in.
Yeah.
It's, all bad.
Yeah. 100%.